Imagine walking into a store, credit card in hand, thinking, it's just a quick swipe. But what if I told you that one swipe could make money for you instead of just spending it? Most people treat credit cards like financial enemies, yet when used right, they can be powerful tools to grow wealth and save big. In today's video, we're talking about how to make money with your credit card and avoid common pitfalls. By the end, you'll know exactly how to take advantage of your credit card, not the other way around. If you're interested in getting more out of your money, make sure to subscribe to the channel. We dive into practical tips every week to help you build financial confidence and unlock smarter ways to manage your finances. Now, let's dive in by understanding the magic behind credit cards, from the basics to the hidden money-making tips the banks won't tell you. A common mistake many make with credit cards is thinking of them as extra money. Here's the reality. If your monthly income is $3,000, that's your budget. Even if you have a $2,000 credit limit, treating it as additional income leads to trouble. Imagine two friends, Alex and Jamie. Alex earns $3,000 monthly and has a credit card limit of $2,000. He spends carefully within his $3,000 budget. Jamie, on the other hand, sees that $2,000 limit as extra money to burn. By month's end, Jamie's credit card bill is nearly maxed out. Now, Alex has his budget intact, while Jamie faces interest charges, struggling to pay off his credit debt. The lesson here? Treat your credit card as a temporary tool for cash flow, not a boost to your monthly income. When you spend beyond what you earn, you're in a cycle that could land you in debt. A simple rule is to avoid maxing out your credit limit or using more than 30% of it monthly. Keep your focus on spending what you can repay easily. Think of it as a financial workout routine. Just as lifting weights beyond your ability causes strain, spending beyond your means can hurt your financial health. To go even deeper, let's break down why this mindset can be so dangerous. The allure of extra funds on a card can make you feel invincible, like you have all this safety net cash ready to use. But this net has holes. Credit card debt is among the most expensive forms of borrowing, with interest rates sometimes reaching 20% or higher. Spending more than you earn and relying on credit can create a debt spiral where you're only paying interest without making a dent in the actual amount owed. It's like running on a financial treadmill where the incline keeps increasing. Consider Jamie again, who's now in a tough spot because he's maxed out his credit card. Instead of just paying $3,000 as planned, he's hit with added fees, penalties, and interest, which make it even harder to catch up. He ends up allocating his next paycheck not to saving or investing, but to covering his minimum payment. This pattern keeps him financially stuck, paying for last month's choices instead of building for the future. To steer clear of this pitfall, start by shifting your perspective. Think of your credit card as a financial tool, rather than a free pass to upgrade your lifestyle. One of the most effective practices is called 30% utilization. This guideline suggests using no more than 30% of your credit limit. For example, if your card limit is $2,000, aim to spend no more than $600. Why? Credit scores factor in how much of your available credit you're using, and lower utilization means a better credit score and healthier financial habits. Credit cards can indeed open doors to financial opportunities down the road, like lower interest rates on future loans, but only if you treat them responsibly. Use your credit card for planned expenses, purchases you already have the funds to cover, and pay off the balance each month. This way, you're building a positive credit history without falling into debt. Think of it as renting a tool only for the specific task you need, rather than owning it and paying forever in maintenance. Ultimately, credit is a temporary cash flow enhancer, not additional income. Viewing it this way lays the foundation for financial stability, keeping you empowered rather than burdened. Banks love it when customers pay only the minimum each month. Why? Because they make money off your interest. While it seems easy to pay a small minimum each month, the reality is you're paying much more in the long run. Consider two friends again, Sarah and Chris, both with $500 balances. Sarah sticks to the $25 minimum, while Chris pays $100 each month. Chris pays off his balance in a few months, while Sarah's balance barely shrinks thanks to compounding interest. When you pay only the minimum, the unpaid balance accrues interest monthly, making your debt grow faster than you realize. This is why paying more than the minimum matters. For example, if your credit card interest rate is 18%, that can add $90 in interest annually on a $500 balance, a significant cost that compounds quickly if left unchecked. To avoid this trap, consider budgeting a fixed amount to put toward your credit card debt, aiming to pay it off in full each month if possible. If you can't manage that, aim to pay double or triple the minimum. Think of it as a way to buy back financial freedom from banks. Each dollar you pay above the minimum is like putting that money back in your pocket over time. When you take control of debt repayment, you're gaining freedom to allocate your funds toward savings and future goals. Up next, know your card's rewards and maximize them. Credit card rewards can be a game changer if used wisely. A friend of mine, let's call him Sam, treats his credit card like a loyalty program, earning cash back on purchases he would already make. His card offers 3% back on groceries and 2% on gas, so he uses it strategically, paying for essentials only and avoiding impulse buys. Over a year, Sam's method earns him a few $100s. Not huge, but enough to cover holiday expenses or small treats. Maximizing rewards takes intentional planning. Start by identifying the most valuable rewards for your lifestyle. Some cards focus on travel, while others prioritize dining or grocery cash back. Rather than spending just to earn points, let points accumulate on things you already need, like Sam. It's a way to keep your spending in check while still reaping card benefits. For example, if you're planning a vacation, look into travel cards that provide points or miles for booking flights and hotels. By the time your trip arrives, the points could cover part of your expenses. Remember, rewards work best when they're a byproduct of spending within your budget, not an excuse to buy extra. Used right, credit card rewards turn your card into a financial asset, helping you stretch your budget without increasing your debt. To make your credit card work for you, understand the rewards that come with it, like Sam does. If your card offers cash back on groceries or gas, prioritize using it there. And don't just chase rewards. Spend on things you genuinely need. This turns your credit card into a small income stream rather than a source of impulsive spending. Many cards also offer bonus points for certain purchases, like dining or travel. So if you're planning a vacation, using the right card can score you points or even cover some expenses. Think of it as getting a 5% discount on items you buy with cashback rewards. The secret? Let your credit card's rewards help reduce your daily expenses without adding to your spending. With the right approach, rewards can make a significant impact on your budget. It's about learning to be intentional, like Sam, and using what's already there to create value without creating debt. Moving forward, avoid the lifestyle creep trap. One of the trickiest credit card traps is lifestyle creep, the slow increase in spending when your income rises or your credit limit is bumped up. It's tempting to think, I can finally treat myself, but this mindset can lead to credit card debt if unchecked. Think of lifestyle creep as a sneaky upgrade to your habits that's harder to notice. It starts small, a nicer dinner here, a small shopping spree there. Before long, those extra expenses become the new normal, and they're charged to your credit card. To stay mindful of lifestyle creep, make it a rule to keep new expenses within reason. Ask yourself if the added spending aligns with your goals or if it's just for short-term pleasure. When you do receive a raise or an increase in your credit limit, consider setting aside a portion for savings or investments rather than splurging. You're building a financial cushion for future goals rather than falling into spending traps. A useful strategy to avoid lifestyle creep is to automatically transfer any raise or bonus into a separate savings or investment account. This way, your lifestyle remains consistent, while your wealth builds in the background. Another tip? Occasionally review your expenses to identify any gradual increases. Small increases in spending can add up over time, but regular check-ins help you reset your priorities and cut back if needed. Keep your expenses stable and view your credit limit increase as a tool for improving creditworthiness rather than a green light for more spending. A lifestyle upgrade doesn't have to mean more debt. It can mean more control over your finances. Think of it as fine-tuning rather than overhauling. By keeping lifestyle creep in check, you ensure that your spending habits are sustainable, and you're building a solid foundation for financial independence. By the way, if you're enjoying this video so far and want more content like this, comment the word "more" so I'll notice. All right, let's get to the part you've been waiting for, actually making money with your credit card. Most people don't realize that by using their credit card strategically, they can generate cash rewards, points, or other benefits, essentially creating a small income stream. Imagine two friends, Dana and Steve. Dana uses her card to pay for all her monthly expenses and essentials, paying off her balance in full each month, while Steve only uses his card sporadically and often carries a balance. Over time, Dana accumulates cashback rewards on her planned purchases, avoiding any interest charges since she pays off her balance every month. Steve, however, ends up paying interest without ever building up significant rewards. By using her card as a tool for controlled spending, Dana manages to earn hundreds in rewards annually, money she can use toward travel, purchases, or even direct discounts on her statement. To make this strategy work, aim to put regular budgeted expenses on your credit card. But remember, the key is to pay it off in full each month. Use the card for groceries, gas, utilities, and other essentials where cashback or rewards apply. Avoid carrying a balance, as interest charges will cancel out the rewards you earn. Treat these rewards as a bonus, rather than a reason to overspend. By focusing on essentials and paying off balances promptly, you're essentially earning passive rewards. Many credit card companies also offer rotating bonus categories, such as extra cash back on groceries during one quarter and dining in another. Take advantage of these bonuses by planning your spending around the category promotions offered. For frequent travelers, certain cards also provide additional points for flights and hotel stays, which can cover parts of your trips if redeemed smartly. With a disciplined approach, you can transform your card into a tool for financial gain, allowing rewards to subsidize everyday expenses without falling into the trap of high-interest debt. Used wisely, your credit card can be more than just a payment tool. It's a way to stretch your budget further. Credit cards often come with valuable but underutilized protection benefits, such as extended warranties, purchase protection, and even travel insurance. Many people overlook these perks, but they can save you a lot in the long run. Take my friend, let's call him Rick, as an example to illustrate how these works. He purchased a laptop using his credit card, which provided an extended warranty. A year later, the laptop malfunctioned, but thanks to his credit card's warranty protection, he was able to get it repaired at no extra cost. These protection benefits are like invisible safety nets for big purchases. Many cards offer rental car insurance, trip cancellation insurance, and even cell phone protection if you pay your phone bill with the card. Before making any large purchase, check what protections your card offers. For instance, if you're renting a car, the insurance offered by your credit card could save you from having to pay for separate coverage. Another common perk is fraud protection. If someone makes an unauthorized purchase on your card, you're typically not liable as long as you report it promptly. This can provide peace of mind when shopping online or traveling. Think of these benefits as insurance policies built into your card. They can safeguard your finances in case of unexpected issues. With a little research, you can use these perks to your advantage, making each purchase safer and more financially sound. Cash advances are one of the most expensive ways to use your credit card. Essentially, they allow you to withdraw cash against your credit line, but at a high interest rate and often with additional fees. It's like taking out a payday loan, convenient but costly if you're not careful. Cash advances usually come with higher interest rates than regular purchases, and interest begins to accrue immediately without a grace period. In addition, there's often a cash advance fee, which can be anywhere from 3% to 5% of the total amount withdrawn. Imagine two colleagues, Ben and Rachel, both facing unexpected expenses. Ben decides to take a cash advance from his credit card, while Rachel applies for a low-interest personal loan from her bank. By the end of the month, Ben's interest and fees have started to stack up, costing him far more than he anticipated. Rachel, on the other hand, has a manageable payment plan with a set interest rate, keeping her finances stable. If you're ever in a bind, consider all alternatives before taking a cash advance. A personal loan, a payday loan, or even borrowing from friends or family can often be more financially viable. The best approach, however, is to prepare for emergencies by setting aside a small emergency fund. Even just a few $100s saved up can keep you from needing a costly cash advance. It's also worth noting that many banks and credit unions offer low-interest alternatives to cash advances. Short-term, low-rate loans or lines of credit can provide immediate funds without the high fees associated with a credit card cash advance. Remember, cash advances should always be a last resort due to the high interest and fees involved. Building up a financial safety net is the most effective way to avoid this trap, helping you keep your finances in check even when unexpected expenses arise. Up next, regularly review and negotiate your credit terms. Most people don't realize that credit card terms aren't set in stone. Banks often allow customers to negotiate for better interest rates, lower fees, or higher credit limits, especially if you've been a responsible cardholder. Let's say two friends, Zoe and Paul, both receive notices of a rate increase on their cards. Zoe takes action, contacting her bank to negotiate a lower rate and even has her annual fee waived. Paul, however, simply accepts the new rate, missing out on potential savings. Banks want to keep loyal customers, and a quick phone call can often lead to better terms. If your card has an annual fee, see if it can be waived or offset by rewards. Additionally, negotiating a lower interest rate can save you hundreds over the life of your card, especially if you carry a balance. Banks are surprisingly open to requests from cardholders with a history of on-time payments, so don't hesitate to ask for a better deal. Reviewing your credit card terms regularly can also help you stay on top of new benefits or potential fees. Many people stick with the same credit card for years, unaware that better options are available. If you're not receiving valuable rewards or your interest rate is higher than average, it might be time to negotiate or consider switching cards. With a little effort, you can ensure your card aligns with your financial goals, keeping more money in your pocket and working in your favor. So there you have it. With these strategies, you can make your credit card a money-making tool rather than a money pit. Remember, it's all about using it wisely and avoiding the common pitfalls that turn credit into debt. The key is to treat your credit card like a financial asset, a tool to build your wealth, not drain it. From sticking to mindful spending to maximizing rewards, every step you take to control your credit card use brings you closer to financial freedom. If you found today's video on how to make money with your credit card and avoid common pitfalls, I highly recommend checking out my next video, which complements this one perfectly. Don't hesitate to share this video. It might help someone else too. Subscribe to the channel. And one last thing, let us know in the comments. What's your favorite credit card tip, or how do you make the most out of your card? We'd love to hear your experiences and tips, and your input could help others in the community. Thanks for watching, and until next time, keep making smart moves with your money. See you in the next video.